Portfolio Policy of Enterprising Investors Negative Approach by Benjamin Graham. The aggressive investor should start from the same basic of a defensive investor, namely the division of the funds between the high grade bonds and the high grade common stocks bought at a reasonable price. He will be he will be prepared to branch out other kind of security commitments, but in each case he will want to well reason justification of the departure. It is difficult in discussing a topic in orderly fashion because there is no single ideal pattern for aggressive operation, and the field of choice is wide. Because there is no single identified pattern for aggressive operation, the field of choice is wide. The selection because depend upon only an individual field of choice, and the selection should be dependent only on individual competence and independent, but perhaps equally upon the interest of preferences. The most useful generalization of the enterprising investor or negatively so they are negative. Let some have a high level of great perfected stocks to corporate buyers. Let him also avoid inferior types of bonds and preferred stocks unless they are bought at a bargain level, which means ordinarily a price of at least 30% or under the par of high coupon issues and much less than the lower coupon. He will let someone else buy a foreign government bond issue, even though yield may be attractive. He will also vary of all kind of new issue, including the convertible bonds and preferences that seem quite tempting, and common stocks with excellent earning confined in the present past. For a standard bond investigation, an aggressive investor should do well to follow the pattern of suggestion to an effective con-free and make this choice between a high grade taxable issue which can be selected on the yield of 7.25 percentage and high quality tax free bond at 5.3% and long maturity. Con-free second grade bonds and preferred stocks. Since the late 1971, it is impossible to find first rate corporate bonds in a yield of 7.25% and even more. It would not make much more sense to buy second grade issues. Many of the higher return they offer. In the fact, the corporations will relatively poor credit standing have found it virtually impossible to sell standard bonding, that is convertibles, to the public in the past 2 years. Hence, the debt financing has been done by the sale of convertible bonds or the bond with warrant attached. While place them in separate category to follow the virtual, all the convertible bonds of inferior rating represent only issue which is selling of large discount, which may offer some possibility of substantial gain in the principal value of favorable future conditions, which may means by the combination of improved credit rating of the company and lower grade interest rate. But even the matter of price discount and resulting change of principal gain, the second grade bond this competition is better in issues. Some of the well entrenched obligations, old style coupon 2.5%, 4%, it sold 50 cents a dollar in 1970. Example, American Telephone Telegraph 25 to 8 seconds due to 1976 sold at 51, and Acheon, Topicon and Santa Fe RR 4S due 1995 and sold at 51, and McGraw Hill 37 8S due 1990 sold at 50.5%. Hence, the other conditions are lately 1971 that the enterprises investors are probably get for a good grade bonding, selling at a large discount for the key should reasonably desire in the form of both income and chance of appreciation. Throughout the book, we refer the possibility of us well-defined and protracting market situation of the past may return in the future. Hence, we should consider what policy that aggressive investor might have to choose in the bold field in prices and rises in the high grade issues should return the formal and former. For the reason we should reap in how the observation of the point made in 1975 edition. Well, high grade bonds yield only 4.5 5%. Sometimes something should be said now about investing in a second grade issues, which is readily be found yield and specific return to 8% or more. The main difference between the first and the second grade bond is usually found in a number of times. The interest charges have been covered by earnings. For example, in early 1964, Chicago, Milwaukee, St. Paul, and Peace 5% income debenture bonds at 68 and yield 7.35%. But the total interest charge of the road before the income taxes earned only 1.5 times in 1963 against a requirement of 5 times for the well-protected railroad issue. Many investors buy securities of the kind because they need income and cannot get along with the merger offered to top grade issues. The experience clearly shows that it is unwise to buy a bond or a preferred which lacks adequate safety merely because the yield is attractive. Here the word merely implicates that the issue is not selling at a large discount, thus does not offer opportunity for substantial gain in the principal value. Where such securities are brought in full prices, that is not more than 100, the chances are very great that some future time holder will see much lower quotation. For when the bad business comes, just a bad market, issues are kind prove highly susceptibility severe sinking spell after the interest and debentures are suspended at least in danger. Frequently, there is a pronouncement prices weakens even through the operating result and not all buoyant. The specific illustration of characters of second quality senior issues. Let us summarize the price behavior of the group of 10 railroad income bonds in 1946 and 47. These comprise all these sold in 96 more 1946. This high price averaging 10.25%. But the following year, the group has registered low prices, averaging only 16, loss of 1/3 of the market values in very short time. Peculiarly enough, the railroad of the country had showing much more earning 1947-1946, and the drastic price decline trend countering the business picture was reflecting the sell-off to gentle market. But it will be pointed out the shrinkage. This is income bond that's proportionately larger than the common stocks in Dow Jones Industries list to 23%. Obviously, the purchase of the bond as a cost of 100 could not be expected participated to any extent in the further rise of security markets. The only attractive feature was the income yield. The average about 4.25% against 2.5% first grade bonds. The advantage of 1.75 is in annual income. And the sequel showed all too soon and too plainly that the minor advantages in annual income, the buyer of the second grade bonds, are rising the loss of substantial part of the principal. The example permits us to pay our respects to popular fallacy that goes under the subrequisite of the businessman's environment, that involves a purchase of security showing a large yield that obtainable the high grade issue and carries in corresponding greater risk. It is a bad business to accept acknowledged possible of loss of principal in exchange of merely 1-2% additional yearly income. If you are willing to assume some risk, you should be certain that you will realize a really substantial gain in the principal value of things well. Hence, a second grade 5.5% to 6% bond selling at par almost always a bad purchase. The same issue of 70 might make more sense if you are patenter. You would probably be able to buy it at the level. The second grade bonds and preferred stocks progress two contradictory attributes, which is intelligent investor must bear clear in minds. Nearly all suffer severe sinking spells of bad markets. On the other hand, a large proportion recover their position when favorable conditions return. This ultimately work out all right. This true even cumulative preferred stocks that fails to pay dividend for many years. There are a number of such issues in the early 1940s as consequential of the long depression of 1930s. During the post-war boom period 1945-1940s, and many of the large acquisitions were paid off either in cash or in new securities, and the principals were often discharged as well. As a result, large profits were being made by the people who fell few years previously had bought this issue when they friendless and sold in low price. They may See, where they may well be true that the overall account of the higher yield obtainable on second grade senior issues will prove on the effect of the principal losses. It is irrecoverable. In other words, the investor who bought all such issues are offering price might conceivable fare as well. A long run as one who limited himself in the first quality security or even some other better. But the practical purpose is question is largely irrelevant. Regardless of the outcome, the buyers of the second grade issue of the full prices will be worried and discomforted when the prices decline depreciately. Furthermore, he cannot buy enough issues to assure average result. Now the position is set aside portion for larger income offset of amortize this principal loss, which proves to be permanent. Finally, it is a mere common sense of abstain from the buying securities around 100 if a long experience indicate that they will probably be bought at 70 or less in the next week market. Foreign government bonds. All the investors with a very even small experience know the foreign bond as a whole have a bad investment history in 1914. This was an inevitable in the light two world wars and intervening the world depression and unexplained debt. Yet a few year after every few year market conditions are sufficient favorable to permit the sale of some new foreign issue at a price of an apart par. This phenomenon tells us a great deal about the working of the average investor mind and not only the field of the bonds. We have no concrete reason to concern about the future history and well regarding the foreign bonds as Australia or Norway, but we do know that if when trouble should come, the owner of foreign obligation had no legal or other means of enforcing his claim. Those who bought them those who bought Republic of Cuba at 4.25% in the highest 117 in 1953 saw that the default the interest and they sell at lower 20 cents on the dollar in 1963. The New York Stock Exchange bonds this year was included in the Belgium Congo 51.25 at the 36, Greeks and 7s at 30, and various issue of Poland of low and 7. How many readers have any idea of the repeated vicissitudes of 8% bond of Czechoslovakia since they are first offered in the country in 1992, that is at 96.5. They advanced to 112 in 1920 and declined in 97.75 in 1932, recovery in 106 in 1936, collapse to 6 in 1993, and the recovery unbelievable in 117 in 1946. Fell prominently to 35 in 1948 and sold to low and 8 in 1970. Years ago, the argument of sort are made from the purchase of foreign bonds here or the crown that rich creditors, nations such as our were under the moral obligation to blend aboard. Time which brings so many revenges. Now finally deal with the intractable balance of payment problem of own part which is as credible to the large-scale purchase of foreign bonds by American investors seeking a small advantage in the yield. For many years past, we have questioned the inherent attractiveness of such investment of the standpoint of the buyer, and perhaps we should add now that the latter should be benefits both the country and himself and decline this opportunity. New issues generally. It might seem ill-advised to attempt any broad statement about new issues as a class since they cover the wide possible range of quality of attractiveness. Certainly there will be expectation to suggestion rule. Our own recommendation that all investors should be wary of a new issue, which means simply that these should be subjected to careful examination and usually severe test before they purchase. There are two reasons for the double caveat. The first one is a new issue has a special sales handshake behind them, which calls therefore a special degree of special residence. The second is the most new issues are sold under the favorable market condition, which means favorable for the seller and consequently less favorable for the buyer. The effect of consideration became steadily more important as we go through the scale of highest quality of bonds. through second grade senior issues of common stock flotation. At the bottom, the tremendous amount of financing consisting of a repayment of existing bonds at the call price and the replacement of new issues for the lower coupons. We done in past. Most of the was categories of high grade bonds or preferred stock. Buyers are largely financial institutions, ample qualified to protect their interest. Hence, these offerings were carefully priced to meet the going rate of comparable issues. The high-powered salesmanship had a little effect of outcome. An interest rate fell down, and the lower the buyer finally came to pay too high price for these issues, and many of them later declined appreciatively in the market. This is one aspect of general tendency to sell new securities. All type and conditions were most favorable to the issuers. But the case of first quality issues, the real effects of the purchases are likely to be unpleasant rather than serious. The situation proves somewhat different when we study the low-grade bonds and preferred stock during 1945 to 46 and 1960 to 61 period, where the effect of selling effort is more apparently because most of the issues were probably placed in the individual in-export investors. It was characteristic that offering they did not make an adequate showing when judged by the performance of companies over the sufficient number of years. They did look safe enough. The most part, if it is would be assumed that the recent earning would continue without serious setback. The investor and bankers who bought out these issues presumably accepted this assumption, and the salesman had little difficulty in presuming themselves and the customers are well affected. Nevertheless, it's an unsound approach of investment, or one likely to prove costly. The bull market period is usually characterized by the transformation of a large number of private owned business into companies with quoted shares. It's the case of 1945 to 46. Again, beginning in 1960, the process reached extraordinary proportions until bought and catastrophically close in May 1962. After usually swearing off period of several years, the whole tragic comedy were repeated step by step, 1967 to 1969. New common stock offering. The common paragraphs are reproduced unchanged in 1959 edition with comment added. The common stock financing takes into different forms. In the case of companies already listed, addition shares are offered pro rata of existing shareholders. A subscription price is set below the current market, and the rights of subscription have an initial money value. The sale of a new share is almost always underwritten by one or more investment banking houses. But gentle hope, the expectation all the new shares will take into exercise the subscription rights. Thus, the sale of additional common stock of listed companies does not ordinarily call of active selling effort in the part of distribution firm. The second type of placement with the public of common stock of what were merely privately owned enterprises. Most of the stock is sold for the account of controlling interest to enable them to cash in on favorable market and diversify their own finances. When new money is raised for the businesses, comes often via the sale of preferred stock. And previously noted, this activity followed a well-defined pattern, which is the nature of security market, must brings many losses and disappointment in the public. A danger arises both for the characters of the businesses that the financed and form of financial conditions that make a financing possible. The earlier part of centuries in large portion of our leading companies were introduced to public trading. As time went on, the number of enterprises of first rank that remained closely held steadily diminished. Hence, ordinarily common stock floating were tended to concentrate more and more in relatively small concern. By unfortunate correlation, during some period, the stock buying public have been developed in creating the preferred by the major companies and similar prejudice against some minor ones. This prejudice, like many others, tend to become weaker and bull market and build up. The large quick profit shown the common stocks as a whole are sufficient to dull the public critical faculty. Just a sharpened in aquatic instinct. During this period, a quite number of privately owned concerns are found that are enjoying excellent results. Although most of this was not present to impressive in the record, its figures were carried back, say 10 or more years. When the factors are put together and following consequentially emerge, somewhere in the middle of the bull market, the first common stock flotation made the appearance. That is in priced non-attractively. Some large profits are made by the buyer for early issues. At the market rise continuously, the brand of financing grow more frequently. The quality of the companies became steadily poorer. The price asked and obtained verge and exorbitant. One fairly dependable sign of approaching the end of bull swing in the fact of new common stocks or a small non-descriptive companies offered at a price somewhat higher than the current level of many medium-sized companies with a long market history. It should be added that very little of common stock financing ordinarily done by the banking house of prime size and reputation. The headlessness of public and the willingness to sell the organization to sell whatever may be profitable to sold can have only one result: price collapse. In many cases, the main new issues lose 70% more of the offer price. The situation worsening, aforementioned factor that the bottom, the public has a real aversion to very kind of small issue that is bought so readily in a careless moment. Many of the issues fall proportionately as much below the low value of formerly sold above. Elementary requirement for intelligent investors: ability to resist blandishment and sales when offer a new common stock issue during the bull market. Even one or two has found that can pass severe test of quality and value. It is probably bad policy to get mixed up with the sort of business. Of course, the salesman will point to many of the issues which had a good sized market advance, including some they go up speculatory and every day they are sold. But the part is and speculative atmosphere. It's easy money. For every dollar you make in this way, you will be lucky if you end up by losing only two. Some of these issues may prove excellent buys a few years later when nobody wants them. They can be had at a small fraction of a true worth. In 1965 edition was continuous our discussion in the following subjects. This broader aspect of the market behavior since 1945 had not led themselves well to analyze based on the long experience. The development of new common stocks floating proceeds exactly in accordance with the ancient prescription. It is doubtful whether we ever before had so many new issues offered of such a low quality and with such an extreme price collapse. And we experienced 1960 to 62. The ability of stock market the whole is disengage itself rapidly from the disaster to indeed an extraordinary phenomena, bringing back the long buried memories of a similar invulnerability to shown in the great Florida real estate collapse in 1925. There is a return of new stocks of fearing madness before the present bull market. Can anyone be definitive close? Who knows? But we know what is an intelligent investor will not forget what happened in 1962. Will let others make the new batch of quick profit in the area of experience and consequent of harnessing losses. We follow the paragraph 1965 edition citing a horrible example, namely the sale of the stock of Antha Maintenance Co. at $9 in November 1961. A typical fashion of the share promptly advanced to $15. Next year there was 23. Then was in 1964 at 7 and 8. 23 by 8 and 7 by 8. The later history of company was an extraordinary sight, an illustration some of the strange metamorphoses that have taken place in American business, great or small, in recent years. The curious reader will find out the older and the newer history of the enterprise in Apex. To me, it's difficult to provide even more harrowing example taken from the most recent version of the same story. This covers 1967 to 1970. Nothing can be more part or purpose of the AAA enterprises, which happened to be the first company listed in the Standard & Poor's stock guide. The shares are sold in the public for $14 in 1968, promptly advanced to 28, but early in 1971 is quoted to diminish to 25 cents. Even the price represented a gross overvaluation enterprise since it had just entered the bankrupt court in the hopeless condition. There is so much to be learned in such important warning to the glinted from the stories of flotation that have reserved it from a detailed treatment of below chapter. Commentary. If you admit mistakes when it is size of an acorn, it is easier to repair than if you wait until it becomes size of a tree with a deep, wide-ranging roots. Even if you are enterprising investor, you still need to be a defensive, both against who? Those who want to be lock up your money and those who want to keep your constant motion. Focus on what is to be fun. I'm focusing on what not to be vital. Otherwise, as Graham wants, for every dollars you make, the enterprising investor, you will be lucky if you end up by losing only two. Alternative investors. One potential mistake of the enterprise investors is locking money up for years for high fees in pursuit of big gains. Those investors see often depends on fees. The more bankers, brokers, and financial advisors can earn from the asset, and the harder they will push to sell it. In 1980s and 1990s, there meant constant pressure of investors to buy high-cost mutual funds and annuities, as well as an initial public offers. Lately, the arm twisting has shifted to alternative assets such as hedge funds, private equity funds. They buy our entire companies, the virtual capitals that financing startups. The private credit funds specialize with non-trader debt and portfolio private real estate. These assets are tantalizing the enterprises, investment promising potential superior return, and this are the one clone of owning fund that is historically available only to the elite. Prestige comes at price. Between 2013 and 2022, the private equity, venture capital, real estate, other private funds rise around 11.7 trillion worldwide dollars. According to the PitchBook data, the investor paid managers and marketers hundreds and billions of dollars in cumulative fees and expenses. The cost of investor pay at one popular fund of fund, a non-trader portfolio that invests in the bundle of others non-trader funds, an extreme but hard techniques. The fee high. Fees of the fees and expenses leading to alternative fund. Upfront fees, maximum sale charge 3%, annual charge 1.2%, interest pay on borrowing 0.02%, other expense 1.6%, acquired fund fee and expense 0.75%, total annual fee 7.49%. Note the sale charge is exceeded by offering price. This expense a percentage of the net asset. So the prospective Skybridge Multi-Advisor Hedge Fund Portfolios LLC Multi-Strategy Series July 2024. Two things are possible. One certain, you might get a good return, you might be able to get your money out when you need to, and you will pay high fees. Alternative funds often don't trade publicly or even disclose exactly what they own. Many updates these prices and permanent withdrawals. Now, only monthly and quarterly, sometimes even less than. The promoters say these funds operate in a private market dominated by sophisticated investors, immune to long short-term pressures by the public markets. Therefore, the story goes, alternative offers longer investment horizon, lower risk, high returns, making their fees worth paying. Let's think about it. Does the absence of the public trading mean the price can't go down? Or of course, the venture capital slumped, 65% of technology stocks collapsed in the early 2000s. The private real estate lost 63% during the global financial crisis in late 2000. The market work best when they are both deep with the participant and wide with a strong difference of opinion. That's a good description of public trading in the stock market merchant time. The private markets far participant who trend moves the same circles and share similar benefits. They hold the similar portfolios. Instead of being deep and wide, the private market shallow and narrow. Rather than being independent, they are codependent. In such a clubly atmosphere, a private market valuation can be end up really more unfaithful guesswork and groupthink that is original analysis. A survey nearly 900 venture capitalists reported that when deciding which companies to invest in, 45% often makes a gut decision and 9% say there is no financial metrics to all. A survey of dozen of private equity Executives found that whether the company is cheap is a major determine on whether to invest. And very few evaluate companies by estimating the future earning cash flows. Not cash flow. Look at the Firecourse or blood testing startup Thermonoise Inc., the office sharing firm WeWork, and the cryptographic exchange FTX. The private venture capital market valued Thermonoise was 9 billion in 2014, the FTX 32 billion in 2022, WeWork 47 billion in 2018. Thermo shut down in 2018. We found its founder was sentenced to 11 years prison in fraud. The FTX and WeWork filed a bankruptcy protection in 2023. Respectively, the FTX founder Sam Bankman-Fried was sentenced to March 24, served 25 years in prison for stealing billions of dollars from the exchange customers. These flames out we fund by some of the world's most renowned hedge funds and private equity venture capital firm, which charge gigantic fees from the due diligence they apparently don't do. The public stock market makes up pure mistakes too, but it doesn't pretend to be an omniscient. It doesn't charge any arm and length. To invest like an Yale, be like a Yale. Long-time head Yale University engagement David Swanton, who died in 2000, the pioneer investing of the alternative hedge fund, the private equity, and non-trading real estate. Over 35 years, the Yale portfolio gained an average 13.1% annually, far surpassing of peers in US and global stock markets. Swain explained that the private assets more and more risky and less liquid than the stock bond, and therefore he could earn high return. At the same time, he warned the gap between winners and losers in private assets is much wider than the public market. Therefore, the potential superior return is alternative fund, which can be captured only by specialized investor who is withstanding higher risk and lower liquidity. To invest in this ale, you must be like ale. It is extraordinary advantages, expertise, time, size, resilience, cash, expertise. A large expert staff of ale specializes analyzing this fund. Do you advise how long deep experience studying alternative funds, fees, managers, methods, and valuing assets. Time from 1701 and likely to survive a century more. Ale has a luxury to invest for decades of time. Do you? Size. The ale endorsement exceeds 40 billion, granting a special access to the world's best alternative fund and enabling to diversify across many at once. Can you? Resilience. As perpetual institution, ale can outlast severe in terms, even permanent losses on the private fund. Can you survive deep loss and enable you to sell? Cash. Ale does additional income from tuition, gifts, grants, so it can cut spending if its portfolio outperforms. And it can deploy surplus capital when falling markets create bargains. Do you have a multiple source of ample income? If, but only if, you can answer yes to all the 5 of these questions, alternative investment must be right to you. Push back against when what became pushed, pension and endorsement. Ultimate sophisticated investors just sunk 30% to 60% of the asset into alternative fund. As a result, investment consulting Richard Ennings estimated that the institution have underperformed simple portfolio, roughly 70% stock and 30% bond, by much of 2% points annually to 2008. Yet promotes say you can be alternative fund to earn superior return. Can you? In addition to the guidance to the invest like ale and be like ale, you should be really on some of the virtues. I desire a commentary on introduction. Independence will tell you not to invest in alternative just because everyone else in humility will console you. Then the individual investor can be unlikely to be offered an opportunity to invest in a few superlative fund that welcomes giantly like ale. The skepticism will remind you that the private funds are hyped by salesmen and earning the fat fees. That survivorship bias skew the report member, and that even most institutional investors don't come out ahead of alternative asset. Bargain for error. While the financial industry pressure many enterprise investors to lock up the fund in alternative fund that will charge high fees and perpetuity it will goading others with putting money into perpetual motion. During the boom of 2020-21, many inexperienced investor bought risk asset with a bargain debt money they bought from the brokers. Like all the forms of leverage, bargain increases your potential gain and magnifies your potential loss. Many trading apps encourage a newly minted investor to take on a margin of describing it in a way of doubling your buying power. Margin is also doubled by losing power. Imagine you buy 100 stocks of $50 if a 50% margin and regular limit in US, and $5,000 is paid to the 500 in your money. 2,500 come from your broker. If your stocks goes up $75, share is over the total 7,500. The gain is 2,500 or 100% profit on the money you put. If you put your entire 5,000 yourself without borrowing, you would have only 50% gain. What happens if the stock goes down, not up to $25? If you use only your own money to buy it, your holding would be worth 2,500 and 50% loss. If you use margin, the whole 2,500 loss would be incinerated your entire investment. Ben Graham himself was nearly wiped out of the margin debt of Great Depression. A mistake was never repeated. I have been the slightest doubt since 1963. 9 people out of the 10 who had margin accounts with the brokers are ipso facto speculators. I believe that Graham means that using the margin can transform you unwittingly from the investor or speculator. Let's say the use Graham words of chapter. Upon through analysis, your desire to stock, promise safety principle and adequate return. You intend to hold it for many years, even decades. If you bought that stock and margin and goes down, it becomes even cheaper than you bought it, but you might not longer be able to buy more. You'll have to add cash to your account just to keep your broker sizing the stock from your margin call. Constant update of brokerage app on your phone can crack up the anxiety and see the sidebar. Fear could make you freak out and sell a stock you intend to hold. In 2022, margin loss plumped from 519 million to 371 million according to the Federal Reserve, probably because the brokerage customer paid them off with a panic selling the stock to prevent even worse loss. One final point: hedge funds, private equity and private credit funds, as well as other alternative portfolios commonly use leverage. Even though you might not have borrowed to invest them, if they borrow to buy the asset, they have effectively taken margin through them, and that makes your overall portfolio riskier and handicap that promotes alternative almost never mentioned. Absorbed. Half of world population is expected to suffer in myopia of 2050. Although the problem is too new to have been comprehensively studied, some vision scientists believe that excessive use of smartphones may be contributing to the world's wide epidemic nearsightedness. Some of the starting with the little screen of few hours every day might retrain your eye away from easily focusing on distinct object. So it is might retrain your mind away from getting to achieving long-term investment goals. Study in Brazil, China, North Korea, elsewhere have found that young people who can't put their smartphone down tend to make impulsive decisions. The smartphone addicts prefer smaller rewards sooner over large rewards later. They are all realistically individual to losers and struggle distinctly profitable for an unprofitable gamblings. Overusing of smartphones can also impair your ability to solve math problems and think creatively. The people who run your online brokerage know all this. That's why they want you to trade your smartphone apps. The more time to spend on your device, the more time they are likely to trade, making money for the brokerage regardless of whether you make any of the yourself. In old age, you have to talk to your stockbroker over the phone face to face before purchase a sale. That your broker punitively high commissions introduce a layer of fractions between your impulsion and your action, and the stockbroker was out of pick in your pocket. You know it. Nowadays your stockbroker is your pocket on your phone. That would lead to not only just a visual myopia but investing myopia as well. SPA speculative fever. Another temptation of enterprising investor is that player to join forces with celebrities and glide along this slip stream towards a great wealth. Another temptation was enterprising investor to the player to join forces with the celebrities and the guile among their spill stream towards greater wealth. The reason here is the wealthy influencers or professional athletes Stephen Curry and Serena Williams, musician Justin Bieber and Eminem, actor Gwyneth Paltrow, Kevin Hart, stores and MTS and non-fungible tokens help set off the buying frenzy of digital assets. Among the hottest NFT were board Apache Club, colorful electronic caricatures of weary eyes, subby-faced pyramids and sailor suits, sometimes selling for more than 1 million. By late 2022, trading volumes had collapsed and many NFTs had fallen in price by more than 90%. Perhaps no recent investment benefited more than famous backers and special purpose acquisition companies. SPAC has no assets or earning. They are bet on something that doesn't exist yet, as they raise money through IPO or initial public offering in stock to buy other firms on a predominant deadline over 24 months. In 2020-21, such celebrity enterprises or airlines and music magnate Richard Branson and former Facebook executive Chamath Palihapitiya attract countless investors to buy shares of SPAC. This break of shining moment of fame seemed to be ensured. Further, 2022, 248 SPAC raised total of 83 million US and 2021 613 raised more than 160 million. More of this business of the year gains more than 50% of single day at attracting swans of new buyers. Unfortunately, Graham wants Chapter 6 large and quick profits. They are sufficient to dull the public crucial facility yet sharpening acquired instincts. You can't build a long-term wealth in blind faith bets on millionaires to act as in best interest. Other assets and earning will materialize out of the thin air. And if the only research you did was to notice the presence of famous name, you forgot Graham injunction. The enterprise investor must commit some significant time and energy before buying any asset. SPAC bristles into conflict with interest. Even the glance of IPO prospectus and disclosure documents and typical offering could unfurl blazing red flags include insider pays a little tenth of the penny per share to contribute 20% of the company. Insider reserves the right to compete directly against SPAC with their own companies. The manager potentially get rid of acquisition targets and giving them incentives to recommend deals to personal benefit from. Independent directors mean to serve as a watchdog and receive tens and thousands of shares of fraction of market value. No assurance that insiders will remain invested in SPAC. No assurance that SPAC will ever find a business to buy. SPAC is often called a bank check companies because outside the investor gives the insider a catchy black sheet to spread the proceeds on just about anything. Investment bank earn 2% fee, 5% fees on anymore. When insiders or make hundreds of millions of dollars for pushing asset into the investing public, they have an incentive to push very hard and go out of getting good. A deal of a good fizzled SPAC included. Between February to August, SPAC lost 100 billion and combined market value. The Sheldon has any investment turnover so fast from a success of a slaughterhouse. No shortcut. The problem is that the investor never learned a lesson. It is that they learned the wrong lesson. If you speculated NFT, SPAC and got wiped off, the lesson was learned was probably never speculated on NFTs and SPAC again. And the lesson you should have learned is, however, never speculate again. This is because the next bound of market and madness won't be tempt you to NFT or NPFCs. This will be some few distribution and transformation of sound completely different and utter selective. Even investors graze towards out of the common intention to same old stories. The quest for the Holy Grail is a high return to low risk with no work. In 1980s to 1990s, it was a mutual funds run the attractive managers. In mid 1990s, the emerging market. In the late 1990s, the interest stocks. In early 2000 is a real estate, and inverse funds a benefit of falling market. Next, it is a private alternative cryptocurrency, NFT, SPAC. The quest of the investing Holy Grail is always futile. The earn higher than the average return. You must take extra risk and you must commit additional time and effort. You are kidding about yourself if you think there is a shortcut.